All right, so I am recording on the cloud here. Hold on one second. Okay, so we are now going to look at notes receivable, how we recognize notes receivable, the valuing of notes receivable, and then the disposal of notes receivable. So we're going to be getting some new information here. Some information is going to look familiar, but some of it's going to be new information. And what you're going to have to be doing is some math before you actually are able to do your posting, just like we've had to do in some of the other areas in our class. You'll have to do some math before you're able to do your post for the class. So hold on one second. I'm sorry for that noise in the background. Sorry about that. Okay, so as I mentioned before, when we were looking at accounts receivable versus notes receivable, notes receivable is different from accounts receivable because accounts receivable is an ongoing account, what they call a revolving account, where you charge and pay and charge and pay. When we look at notes receivable, a note is also a promise to pay, but a note is something that is negotiated every single time you make a purchase. Every single time you make a purchase, and you have to negotiate a note, and you have to negotiate the terms of the note, the interest rates, things of that nature. And notes generally do have interest rates, which makes them different than accounts receivable. So we might find a note if we make a purchase for something, but so either for service, or if we make a purchase, or we might actually find a note that is in an exchange or in a settlement for an accounts receivable. So let's say that you have a customer, and your customer calls you on, you're trying to collect from your customer, and your customer says, you know what, I'm not going to be able to pay you for at least 6 months. And so you negotiate with that customer and say, okay, well, we'll take it off of an accounts receivable. We'll give you a note. We'll extend the amount of time you can pay us, and you're going to have to pay us interest, but we'll negotiate a note for you to be able to pay us off. And they say, okay. So that would be a settlement of an accounts receivable. And so we're going to learn how to do the accounting for that as well. So when you're dealing with notes, this is kind of funny because this shows you, what would be on a actual note. The reality is, though, a note is a legal size document, and it's often several pages long, multiple pages long. However, this information is found on a note, but you're going to be getting the information in a paragraph in Wiley. You're not actually going to see an actual note. So it's going to list what the amount of the note is in dollars. It's also going to list the amount of the note written out. It's going to have the length of the note, and here this one's 2 months. It's going to have the date of the note, where it was issued. It's going to have who the note was, who the payee of the note is, who the maker of the note is, and then what the terms of the note are, or what the interest rate is of the note. That will be listed on the note as well. So like I said, though, you're going to be seeing these notes in paragraph form. They're going to give you the information in paragraph form. Okay, so when we are doing information around notes, right? They're going to be giving you interest, and interest is either going to be expressed in months, days, or years. Now, I don't have years on that top part there because it's very rare that interest is expressed in years in the problems that you are seeing here. So you're going to have to know what the term is. So if it says it's a 360-day note, then it's a day note. If it says it's a 25-month note, it's a month note. And that is going to affect this section here. This is time in terms of 1 year, okay? So I'm going to look at this next slide really quick. Okay, I do have it there. So I'm going to go to the next slide here. And well, first let me tell you this. To compute the interest, it's the face value of the note times the annual interest rate times the time. And times the time is the key piece that you have to figure out that really can make your problem correct or incorrect, okay? And that's what we're going to do in some sample problems here today. All right. So if we look over here, this is giving you an example of 3 different types of notes. Okay. Now, remember look at this first one here. It says $730, 12%, 120-day note. Okay. So here's what you need to remember. Look in the time column there. Do you see where it says 120 over 360? Okay. Anytime it's a day note, your denominator, the bottom number is going to be 360 whenever it's a day note. Now, we know there's 365 days in a year, right? But in accounting, we use 360 days, and your book describes why they use 360 and not 365. But what you need to remember is that if it is a day note, the denominator is always going to be 360. Now, the numerator, in this case, they're showing 120. They're showing the full length of the loan. You're not always going to have the full length of the loan. You're going to have whatever amount of time has passed that you're trying to figure out interest for, okay? So you're always going to have to figure out what the numerator number is. This example here, they're showing you the full length of the loan, okay? Now, for the next one, it is a $1,000, 9%, 6-month loan. So if it's a month loan, the numerator or the denominator on the bottom is going to be 12, okay? If it's a day loan, the denominator is going to be 360. If it's a month loan, it's going to be 12. And actually, the next one down shows a year over 1. You're not going to see any like that. You're either going to have a day note or a month note, okay? So make a note of that. If it's a day, if it says it's a day note, if it's 10 days, 20 days, 360 days, 5,000 days, if the word day is in the note, that is 360 on the denominator. If it says it's a 6-month note, a 1-month note, a 12-month note, a 5 million month note, it's going to be 12 in the denominator. Okay. All right. So you have that. Okay. So let's go to the next slide here. All right. So put that aside for a second. This is just showing an entry when you are using a note to settle an accounts receivable. Remember I said that if you have a customer that can't pay and you want to give them a chance to pay over a longer period of time, you might negotiate a note with them. So this says Calhoun Company wrote a $1,000 2-month 12% promissory note dated May 1 to settle an open account. Prepare the entry that Wilma Company makes for the receipt of the note. So in this case, you're going to debit notes receivable because you're getting a note, and you're going to credit accounts receivable because you're clearing out the account in exchange for notes receivable. So you will see this entry in your homework. You will see this entry on the exam. So this is an example of an entry that is an exchange for a note, okay? I mean, accounts receivable exchange for a note, or what they call a settlement. You're doing a settlement for an accounts receivable and you're transferring it over to a note, all right? On the next slide here, short-term notes receivable at their cash net realization or realizable value. You don't need to worry about this. You're not going to be doing anything with valuing notes receivable, so you can skip that whole section there. So don't worry about that. Nothing for you to do there. Disposing of notes receivable. So there's different things that can happen to a note. A note may be held to its maturity date, and at that point, you would be collecting the payment and disposing of the note. A note might default, so that would be the person who's paying the note defaults, and you have to get rid of the note. Or the note holder speeds up the conversion of the note by selling the note receivable to someone else, and that's kind of similar to that factoring we looked at in the other chapter. We're only going to be seeing, I believe, that the note reaches maturity, or we may see that the maker defaults on the note, okay? All right, so going down to the next slide. Honoring and dishonoring notes. So all that really means is that if someone has honored the note, they've paid the note in full at their maturity. If they've dishonored the note, then that means the note has not been paid. And it's not like an accounts receivable. If it hasn't been paid, then you negotiate. If a note has not been paid and it's been dishonored, it didn't get paid by its deadline, it's not negotiable anymore. It's something that would go directly into a collections approach. So honoring a notes receivable. Okay. Now this is where you really have to pay attention to the timing, to the dates. Okay. So let's look at the problem first, and then I'll kind of explain the calculation on the bottom. All right. Woolder Company lends Higley Incorporated $10,000 on June 1, accepting a 5-month, 9% interest note. If Woolder presents the note to Higley Incorporated on November 1, the maturity date, Woolder's entry to record the collection is, and then here's the collection. Okay. Now, when you're figuring out when a note is being paid and you're figuring it out, the first thing you have to ask yourself is, when was the last time interest was done? When was the last time interest was done? If the problem doesn't tell you, you assume it has never been done. Okay. So you want to make a note of that. When was the last time interest was done? If the problem doesn't tell you, you assume the interest has never been done. So in this problem, they don't tell us anything about when the interest was done, right? So we assume the interest has never been done. So we have to figure out what the interest is that we're going to be receiving. So we take the face value, $10,000, times the interest rate, 9%, times something over 12. And the reason why it's over 12 is because it said it was a 5-month note. Remember, it said it was a 5-month note. So if it's a month note, then we know that it's supposed to be over 12, right? So where does the 5 come from? Well, this is where the 5 comes from. So if we, actually, I'm going to rewrite this down here in a box where I can actually put more information. So we've got face value times what they call APR, or times APR, or annual percentage rate, right? The APR times time. Okay, that's what the formula is called. Face value times rate times time is what they call it. Times rate times time. Okay. So in this problem, it's $10,000 times 0.09, because it's 9%, times 5/12. Okay, and I'm going to tell you how they get that 5. And that comes to $375. Okay, so, all right, so I'm just going to put that there and get rid of that box there so that it's easier to see. All right. So the 5/12. So the 5 is the amount of time that has passed from the last time interest is done until the time that you're making the payment. So the 5, the top number, the numerator, comes from the last time interest was done until the time that you were making the payment. And this is why it becomes important that you have to know when was the last time interest was done. Okay. If it doesn't tell you, it's never been done. So in this case, it doesn't tell us. So we have to assume it's never been done. So this 5 right here, right? It was June 1. So that means that that 5 represents all, the 5 is equal to all of June, July, August, September, October. 1, 2, 3, 4, 5, October, okay? Why is it all of June, July, August, September, October? Because they're paying the note in full on November 1. So they've gone the full length of the loan. So June, July, August, September. And you say all of, because if the note would have occurred on June 30th, you wouldn't count June at all. It would be all of July, August, September, October. But this note originated on June 1. So it's all of June, July, August, September, October. 5 months, 5/12. Now you have to convert the 5/12 into decimals in order to get this into the right format that you can calculate. All right, so where's my calculator here? 5 divided by 12 is 0.41666, 0.41666. So our problem actually becomes $10,000 times 0.09 times 0.41666. Okay. And that's not highlighted there. All right, so that is how you do the calculation for the interest rate. And this loan was one that made it to maturity. Okay. So now we know how much the interest is, $375. So how much money are we getting? We're getting the face value of the loan, which is $10,000, plus we're getting $375 in interest. So we are going to debit cash for $10,375. We're going to credit notes receivable for $10,000. And then we are going to credit interest revenue because we've earned $375 in revenue for $375. Okay. So that's the entry for this note, honoring of a note that has reached maturity. All right. Now let's go to the next slide. And in the next slide here, suppose instead that Wolder Company prepares financial statements as of September 30th. The adjusting entry for Wolder is for 4 months ending September 30th. So they're doing an adjusting entry for the interest. So whenever you're doing an adjusting entry for the interest, you ask yourself, when was the last time interest was done? If they don't tell you, you assume it's never been done. Now, in the real world, you would do it every month, but in these problems, they're not going to be that way. So it doesn't tell us, so we assume it's never been done. So we know that the loan originated on June 1. We're doing this entry on September 30th. So it's all of June, all of July, all of August, and all of September, 4 months. So that becomes 4/12. So we're going to do the entry to recognize the interest that we've earned. 10,000 times 9% times 4/12 is $300. So on September 30th, we're going to debit interest receivable because we're not being paid the interest at this point. We're just doing an entry to accrue the interest, okay? And you may have remembered this from the adjusting entry chapter. And then we're going to credit interest revenue, $300, because we've earned $300 worth of money, okay? Now, when we go to the next slide, you're going to see here that something's a little bit different, okay? Because remember how I said you have to ask yourself, whenever you do, I went back to this slide here because I want to copy and paste this information and paste it on the bottom of this one here. Whenever you do a payment of a note, right? The first thing you ask yourself is, when was the last time interest was done, right? If it's never been done, or if it doesn't tell you, then you assume it's never been done, right? Well, we're going to ask ourselves that question again, and we're going to see that it has been done and how we have to figure it out differently, all right? So this is 1/12 and this is $75. Okay. So we go back to the problem. Prepare the entry Wolder would make to record the honoring of the Higley note on November 1. Now this is assuming we did the accrual of the interest on September 30th, right? So the first thing we ask ourselves is, when was the last time interest was done? The interest was done on September 30th, okay? So now we have to ask ourselves, is the interest current? Is the interest current? Well, is there a gap in time from the last time we did interest to the time that we're doing the payment? So the last time we did the interest was September 30th, and we're paying the bill on November 1. So yes, there's a gap in time. So now what we have to do is figure out the interest for that gap in time, okay? So the last time interest was done was September 30th, and we're paying this on November 1. So we have to do interest for all of October, okay? All of October. So it's 10,000 times 0.09 times 1/12, which equals $75, okay? And then this is how the entry is done. We're still getting $10,375 cash, the principal plus $375 in interest. We're going to credit notes receivable, $10,000, to clear that out. We're going to credit interest receivable, $300, to clear that out. And then we're going to credit interest revenue, for the $75 that we just figured out. We're not putting it into a receivable because we're not going to receive it later. We're getting paid right now. So we need to recognize that revenue. So this would be an entry of a payment being made to us and the interest was not current, and we had to do an entry to bring the interest current when we received the payment. Okay, so I'm going to stop the recording there.